Welcome again to my accounting tutorial channel where I translate complicated topics to a storytelling version, sort of. So, we ended the last episode with our original loans receivable problem, but we added this information. So, let's go through it again. Okay? Again, you are Baby G, the creditor, who extended a loan to Baby M. So Baby M is to pay a principal of 5 million at the end of the maturity date, which is after 4 years. So Baby M is also to pay 10% interest per year or 500,000. That's again 5 million times 10%. And again, that's every year for the next 4 years. So that's the arrangement or the agreement. Now, BBG did not give the whole 5 million as proceeds to Baby M. So BBG deducted first this 5.5% from the loan. Or if you convert it to amounts, that's 275,000 as charged for origination cost. But BBG did not actually incur that much. BBG only incurred 44,779. Now, because again of this two origination costs data, we needed to find the effective rate that we will use, which we did, and that's 11.5%. Now, for the twist, Baby M, the debtor, at the end of year 2, unexpectedly requested to modify the terms of the payment. So the terms are the following. So Baby M is to pay 4 million principal only at the end of the maturity term. And interest will not be paid already due to financial incapacity. And based on BBG sources, BBM is actually already starting its process for filing bankruptcy, which is why BBG agreed to the payment terms and concluded to recognize 100% of the possible impairment loss. So, what will happen? In the measurement and the journal entries of the loans receivable account in the next 4 years, based on this. So, let's talk about that after this. What will happen is, at the beginning of year 1, the loans receivable will still be valued at the loan principal minus the origination cost received from the borrower plus the direct origination cost actually incurred by the creditor. So that's the same as before. And again, that's 4,769,779 times 1.115 equals 5,318,304. And then minus another 500,000, which is the interest payment, equals 4,818,304 times 1.115 again equals 5,372,409 minus another 500,000, and we will have 4,872,409. Now, if you have been following this series, you will notice that these measurements of loans receivable in this year 1 and then this year 2 are the same with the past episodes. So it is because this twist here only affects the time after this balance. So in year 1 and year 2, we are assuming that everything is fine. Baby M is still financially capable up to this point. However, at the end of year 2, the debtor BBM negotiated with you as Baby G as the creditor to only pay a reduced amount of 4 million at the end of the maturity term. Plus, it will not pay already any interest because of financial difficulty. But then again, you agreed. It is because you found out that the debtor filed for bankruptcy. So, what will happen? Well, you need to get the present value of the revised future payments, which is again 4 million based on the new promise of Baby M. So to get the present value, you need to multiply this with 1.115 raised to the power of negative 2. Because again, 2 years has already passed, and also there are 2 years remaining up to the maturity date. Okay, so that's negative 2. Now, if you simplify this, you will get a present value factor of this one. Now, this factor times 4 million equals the new receivable already of 3,217,439. So, this old receivable will be crushed out automatically. Now, let me emphasize, this is not the same with the debt restructuring modification terms topic that we discussed in the past episodes, where we still need to know if there is substantial modification or there is no substantial modification. Because if there is substantial modification, we are going to change the old balance. And if there is not, there is none, there is no substantial modification, then we will preserve the old balance. Guys, it will not happen here. Substantial or no substantial modification issue happens only if you are the debtor. But right now, in this particular series, you are the creditor, right? So, moving forward, the difference of this old versus this new balance, which is 1,654,917, is the impairment loss amount that we are looking for. And actually, guys, this is not automatically the impairment loss because this loss still needs to be multiplied with a probability percentage in order to get the reasonable balance or reasonable amount of loss that you might suffer as the creditor. But since, in the problem, it was stated that BBG chose to recognize 100% of the possible impairment loss, then let's follow that and let's recognize this whole amount as impairment loss. Okay? Now, what will happen next? Let's talk about that after this. Now, the next thing that will happen is we need to make an entry to recognize an impairment loss because there is a decrease in receivable from here to here. So, how do you do that? So, debit impairment loss and then credit loans receivable for 1,654,917. Okay? Now, this credit loans receivable here, you can use this if you are going to make a direct to the point entry. But you have an option. Actually, it can be substituted with an account called allowance for impairment losses, which is another contra asset account of loans receivable aside from the unearned interest income that I introduced in the past episode. Now, again, you can use this loans receivable as credit or this account allowance for impairment losses. And actually, it's up to you because the substance will still be the same. Actually, if you use this allowance for impairment loss account and the unearned interest income account in recording journal entries, and you will be asked how much is the loan receivable balance, you will still have principal minus unearned interest income and minus allowance for impairment losses, which will still result with the same balances that you will get even if you're going to use the direct to the point entries. And another is that even if you use these new account titles in recording or not, the timeline amounts will still be the same. So, that's it. That's the entry for the impairment at the end of year 2. Now, what will happen next? I'll be direct to the point. This new receivable balance will be the ones that will be multiplied with 1.115 instead of this old balance. Okay? And if you do that, you will get 3,587,444. And since the debtor will not pay any interest at all already because of financial difficulty, then there will be no interest deductions. Okay? And this 3,587,444 will already be the balance of your loans receivable at the end of year 3. Now, as for the entry, it's just debit loans receivable because the receivable increased, right? And then, credit interest income for the difference of this one and this one, which is 370,005. But then again, instead of using loans receivable account, you have the option to use allowance for impairment losses as debit. Okay? Again, the substance will still be the same. Now, let's have the last year. 3,587,444 times 1.115 and we have 4 million. So the entry will still be the same, debit loans receivable or allowance for impairment, and then credit interest income. But the amount will be 412,556, which is 4 million minus this one. Okay? And finally, we will receive the 4 million promised. So debit 4 million cash and then credit loans receivable account 4 million. So it's as simple as that. If you're going to use the direct to the point entries of recording. But if not, like if you use the unearned interest account and the allowance for impairment losses, then you have to debit cash 4 million and then you also have to debit the remaining balance of the unearned interest income and the allowance for impairment losses to close those accounts also, and then credit loans receivable account for 5 million, which is the undiscounted amount. So that's it. So let's end this lecture to keep this video short. So if you learned, please click like, subscribe, and hit the notification bell to be updated on my next videos. So thank you for watching, and remember, there is always an easy way to understand complicated things or complicated topics. And you need to find that. So again, thank you for watching and see you on my next one.